Hello, I'm John Bachman. Thanks for joining us here at Newsmax TV. With us now on the phone is Robert Wiedemer. He's co-author of the book Aftershock, Protect Yourself from the Next Global Financial Meltdown. He's also featured in Newsmax's Aftershock Survival Summit. Robert, thanks for talking to us.
Thanks for inviting me on, John.
All right, well, the U.S. economy grew at just 2.2% in the first quarter. The government spent less and businesses invested less, but consumers spent more. What's your take on the pace of the recovery, and can it stand on its own 2 feet without more Federal Reserve intervention?
Well, the recovery has definitely slowed down more recently. We saw durable goods orders coming in significantly lower. In fact, one of the worst durable goods orders reports we've seen since 2009. And that kind of fits in with that fixed investment decline in GDP. So, I think the economy is slowing down. It's certainly not getting the kind of recovery we saw earlier, and that's on a number of fronts, maybe except for some of the consumer spending, but the rest is slowing. In terms of another QE, I think Ben's going to hold off as long as he can, but June is still, I think, a reasonable possibility, certainly if we see a slowdown. I think he's going to be reluctant to do anything too close to the election unless it looks too political. So I think June's probably his make or break month. He either does it then or he probably will wait till after the election.
All right, we talked about the durable goods orders dropping to 4.2%. That's the largest decline since January of 2009. Do you see, or how much weaker, I should say, do you see the economy getting this year?
Well, it'll be interesting. ECRI, one of the more respected firms for predicting cycles and recessions, is predicting that we're on locked in a glide path towards recession. I see some of what they're seeing as well in underlying numbers, things like intermodal railroad transportation, the number of cars being moved around the country down about 4% this year. Things like that. I do see some underlying trends downward. So I guess I would say, by the election, it's not going to look good for Obama at this point, but we'll see. I'm not sure we're going to be in full-fledged recession. I wouldn't say that, but I'm sure we won't be beating these GDP numbers of 2%. I mean, let's keep in mind, things should have been better this first quarter because of the weather and everything, and yet they came out significantly under expectations of 2.5% and well under the hopes of 3%.
Yeah, right. Not the same headwinds as we heard about last year. Now, in an updated forecast Wednesday, the Fed predicted that the economy will grow between 2.4% and 2.9% in 2012. That compares with its forecast in January, when an estimated growth this year between 2.2% and 2.7%. How out of touch do you think that forecast is? Well,
the role of the Fed isn't necessarily to make great forecasts or to predict economic crises. Their track record on that's abysmal. The role of the Fed is to basically keep boosting spirits, try to keep people thinking that the economy's on the rebound and going to get better. So I guess I don't think it's that out of touch. I think it's very much in line with what the Fed usually does, and they're not alone in central banks. The Bank of England does the same thing. They always predict a pretty optimistic recovery or optimistic future. I think the key thing to remember is that the Fed's role is not to be a insensitive, impartial predictor of economic trends. It really is very much to play cheerleader, and whether they say so or not, that's really what it has clearly shown to be doing, at least for the last few years.
Well, it might be working. I mean, let me ask you this: with durable good orders dropping, with the growth slowing down, why haven't stocks tanked despite the weak GDP and some of the other dismal recent economic data?
Well, that's the big question. I mean, the futures this morning actually did fall a little bit. We fell from the high of the futures once the GDP numbers came out. But it's interesting it didn't decline more. I would have thought it would have. Maybe, the good news from Amazon, although their earnings were not great, all revenues were tremendous. I really don't know. And certainly the news around the world was no good. Spain got downgraded. Retail sales across Europe were terrible. So no good news elsewhere. It's a little tough to say. There's always a role for irrational exuberance, but I don't really know exactly why it didn't react a little bit worse than I would have expected.
There does seem to be some head scratching going on. I know you don't like the Fed's forecasting ability, but they're also estimating that unemployment now at a 3-year low of 8.2% will be between 7.8% and 8% by year's end. Where do you see unemployment at year's end?
I don't think it's going to move a whole lot either way. The issue with unemployment, of course, is unemployment can go down just because discouraged workers leave the workforce. So you could have a worsening job market and declining unemployment. So that's always a tricky figure to sometimes try to predict. But I would be surprised if it went below 8% before the end of the year, and it certainly could trend higher. Keep in mind, heading into a recession, jobs don't always fall that quickly. In fact, often job growth is still reasonable just as you're starting to go into a recession. So jobs are not going to necessarily track what the economy is doing short term, which is why I'm not quite so negative on unemployment. Could rise, but I don't think it's going to rise a ton by election time, certainly.
All right, well, the Fed has slightly increased its estimate for inflation by year's end between 1.9% and 2% in January. It predicted inflation at a lower range, 1.4% to 1.8%. Let's talk about inflation. Where do you see it headed?
Well, according to the CPI, remember I see inflation is significantly higher than the CPI that the Fed would be using. I would see, on the CPI, inflation to be relatively tame this year. As I said, it takes a while for the money printing to turn into inflation. So I'm not even going to say my predictions are going to be all that much different from the Fed's on that. Where we're going to start to differ is we go out over the longer term. I think we're going to see much higher inflation over the next 2 to 4 years. But between now and the end of the year, relatively tame.
Well, some economists are predicting a weaker dollar, which will further strain the economy, especially of households, because the dollar will have less buying power. Is this your view, or do you see the dollar strengthening as the euro comes under more pressure?
The news out of Europe is nothing but gloom. I think it's not going to. It may recover a bit with another round of money printing. I think the ECB will reluctantly also be forced to print some money. But the fact that the last round of money printing, which was, keep in mind, the last round was $1.3 trillion that they handed out to banks across Europe, it ran out of steam within 3 months. That's got to be depressing to any money printer that they're not getting more bang for their buck. So I think given the gloom out of Europe, I think that's going to continue to put pressure on the euro. But we've had a lot of gloom out of Europe, and the euro has stayed strong. So, not wanting to make such a boring forecast, but I'm not going to, forecast a whole lot stronger dollar right now, but no, I don't think it'll go much weaker because I think the gloom out of Europe. It might go a bit, but the gloom out of Europe is clearly going to keep pressure on the euro. No question about it, and I don't think that's going to change anytime soon.
Well, let me ask you this: do you think the criticism of the Federal Reserve has been strictly political in nature, or do you think it's merited?
Oh, I think it's merited. I'm not saying there's not politics has something to do with it, but it's definitely merited. I think the Fed is making huge mistakes in what they're doing with the amount of money printing they're doing. It's just one of those things that's not going to show up right away. But when it does, it's a massive problem. There is a reason Germany is so unwilling to print money. Why, of all the countries out there, is Germany the most unwilling? Well, we know they've had one of the most, difficult times with inflation of any major industrialized nation out there. So, it does happen. We've seen inflation before. What the Fed's doing is a huge mistake. It just doesn't show right now.
All right. Well, at the end of this year, the Bush tax cuts are set to expire and automatic spending cuts are set to kick in, a combo described by many as a fiscal cliff that will suck hundreds of billions of dollars out of the economy. Will the election year and politics get in the way of dealing with the fiscal cliff, as many call it, and what can this country expect through tax hikes and possible spending cuts?
I'm always reticent to say we're going to go off a fiscal cliff because it just seems like that Congress will always find some way to keep borrowing more money. I don't know exactly what the compromise will be. I don't know exactly what they'll come up with, but I guess I'm not that worried about it. Because I think that Congress is just not going to do it. I think we're going to, I think somebody will figure out a way to keep most of the tax cuts in. And I think we'll maintain the borrowing. Certainly, if that's one thing you could say for the last few years, it's been true, is that Congress always seems to find a way to keep up the borrowing. Not saying I know exactly how they'll do it, but I guess this is not something that's keeping me up at nights. I really think they'll find a way around it. And I'm not saying that's good. I'm just saying I think that's what they'll do.
Robert Wiedemer, as always, good talking with you.
Thanks so much, John.